Hey, thanks, Sam. We'd like to have you turn over to page 1 of the materials. Our program today is going to be focused on changes made by the Consumer Financial Protection Bureau to Reg Z. They took effect January 10th of 2014, and they deal with the determination of a consumer's ability to repay under the Ability-To-Repay rules and also under point 34 of Reg Z for certain kinds of HELOCs. We're going to go through the different Ability-To-Repay rules and talk about how they use different debt-to-income ratio calculations. So we'll go through each one of those so that you can avoid a violation of this part or these parts of Regulation Z. We're going to explain which of the 7 options under the Ability-To-Repay rule require consideration of a debt-to-income ratio, and then we'll go through the repayment ability requirement for high-cost mortgage loans that are HELOCs. We'll talk about the different methods of calculating debt-to-income ratios. We'll talk about everything from what you include in debt to what you include in income, when you have to use Appendix Q, and a whole lot of other things. On page 2, we reference the fact that this is a rule of the CFPB. On page 3, we note that this stems from modifications made to the Truth in Lending Act, and the rules that we're talking about here, which implement those changes, are found in subpart E of Regulation Z, and there's a lot of good stuff in the commentary, and we will be utilizing a lot of information from the commentary in our explanations. So over on page 4, we're going to start by talking about the scope of the Ability-To-Repay rules, also known as the ATR rules. These are found in point 43 of Reg Z, and they apply to closed-end consumer credit secured by a dwelling. There are exceptions for reverse mortgages, bridge loans, construction loans of 12 months or less, or I should say the construction phase of a construction to perm loan where the construction loan is 12 months or less. And there are other exceptions for loans made by CDFIs and certain other entities that are listed on the second half of page 4 and on page 5. But what you need to know is that we're talking about closed-end consumer credit secured by a dwelling subject to those few exemptions that we've noted. Now, over on page 6, we also are going to be talking about the Ability-To-Repay requirements that come into play on certain kinds of HELOCs. Now, HELOCs aren't covered under point 43, but in a separate part of Reg Z, the high-cost mortgage loan part of Reg Z, there are repayment ability provisions. So the HELOCs that aren't covered under the Ability-To-Repay rules can possibly still have repayment ability requirements if the HELOC is a high-cost mortgage loan as defined under point 32 of Reg Z, shown on page 6 of your manual. The high-cost mortgage loans are ones that are consumer credit secured by a consumer's principal dwelling. There are 3 triggers for coverage. So you have your basic requirements, obviously, consumer credit transactions secured by the consumer's principal dwelling, and then they have to trip one of the 3 triggers that you're undoubtedly familiar with and that are shown on page 6. There's a rate trigger, there's a points and fees trigger, and there's a prepayment penalty trigger. So if you have a HELOC that trips one of those triggers and is a high-cost mortgage loan HELOC, then there are repayment ability provisions. I would note over on page 7, when they amended this part of the rule, they removed one of the exceptions that formerly existed, and that was for purchase money loans. So now you have an exemption for a transaction to finance the initial construction of a dwelling, but previously there was an exemption for residential mortgage transactions. They've removed the exemption for the purchase part of that, and they've kept the other. And previously, open-end credit wasn't covered under your high-cost mortgage loan rules. Now it is. So that gives you the scope of coverage for the types of loans that we're going to be discussing. And Jack is going to walk us through the 7 options for complying with the ability-to-repay rules.
Oh, thank you, Mary Beth. Folks, Mary Beth and I do this all the time. Bite off these huge chunks that are hard to cover in the amount of time we have. We got 120 pages today, which is enough to do a full-day program on it. So you can see already we're moving through here pretty quickly. And one of the decisions we made is Mary Beth had previously in another BOL webinar already covered Appendix Q and items related to that. So we hadn't really planned on covering Appendix Q, but we noticed in some of the questions that we've received, they're directly about Appendix Q. And those are not inappropriate questions. They're part of the topic. We were just trying to divide it up. So we'll attempt to get you answers on there. I also noticed, Mary Beth, and I'm sure you did too, we got some questions. They're great questions.
Yes.
That unfortunately there are no answers to right now. The CFPB hasn't answered it. Now, I would like to be in a position where I could tell the CFPB how to answer those questions. I mean, I'd really like to be in a position where I could tell the CFPB what to do with their reg. But I can't talk about that. It'd be inappropriate for this audience. But anyhow, on options, as you mentioned, we have 7 of them. And we're going to go through each one of them individually here in a moment. So just take the quick tour. On page 8, we have the general ability to repay rules, also known as the 8 factors. And Mary Beth, I refer to that as the lowest common denominator. They're good loans, but they're not QMs. And I know there's a lot of banks out there made the decision we're going to only do QMs, so they're not even looking at the 8 factors. But I think you need to be. I've been saying for a year now, any bank that makes the decision they're only going to do QMs will regret it, and they'll probably back off of that within a few months. And I've already talked to some banks where that's happened, because not everybody's going to qualify for QM, and you're going to be running off some good customers. On page 9, we have refinancing the non-standard mortgage into standard mortgage, and again, we'll be covering in more detail later. Mary Beth and I've talked about this for a year now, and again, we think most of you will seldom, if ever, use that option. All right, it's a very niched little option. And personally, I think the CFPB put in a few too many words, and it makes it almost impossible to use that option, but it's out there. At the bottom of page 9, we have QMs. This is the general QM rule, also known as the E2 rule, and this is the gold standard. This is the best loan you can possibly have in your portfolio, but it can be quite a challenge to make the loan. It's not one that's easy to do. Over on page 11, we have the QM special rules. And folks, I mean, some of you are able to use this, and we'll talk about the criteria later, but many of you can't. You pretty much already need to be involved in originating secondary market loans, Fannie and Freddie and FHA and all those things. If you're already doing that business, most of what you have to do to verify the borrower's ability to pay and get a QM is stuff you've already been doing anyway. There's hardly anything in addition you got to do. So from my mind, if you're already making Fannie, Freddie, or FHA loans, this is by far the easiest option. But again, not everybody's making those type loans, therefore it's not the solution for all of you. And those rules are also only available for a short period of time. On page 12, small creditor portfolio loans. Mary Beth and I were talking earlier. I mean, she meets and talks and works with a lot of banks. I do the same thing. And what I'm seeing from a lot of my clients, particularly the small banks, is this is their option. Now, I've got some banks that like to do balloons, and we'll be talking about their options in just a second. But for standard loans they're holding in a portfolio,